Welcome to the Deep Dive. Our mission is pretty straightforward. We dig into the source material to pull out what really matters, the critical knowledge you need.
That's right.
Today, we're diving into the latest from Conduent, that's CNDT, looking at their Q2 2025 results and the investor call that followed.
And we're really trying to unpack, two main things here. First, how do they manage that big profitability beat? Because it was pretty significant. And second, why is that top-line revenue still, dragging?
Yeah.
We want to get at management strategy and what it signals for their whole transformation plan.
Yeah, and if you just look at the market reaction, it was a classic case of mixed signals, wasn't it?
Totally.
You saw that initial excitement on the margin news, but then reality bit when the revenue figures landed. It's like cost discipline versus, commercial reality.
Exactly. And the profit beat was undeniable. Adjusted EPS came in at negative 13 cents, which compared to estimates looking for maybe negative 15, negative 19 cents. That's a very clean beat, real outperformance on the bottom line.
Definitely gave the stock a quick sugar rush. But like you said, it didn't last. That revenue number, $754 million.
Yeah, that fell short. Consensus was what? Closer to 777, maybe $779 million?
Yeah.
So a noticeable miss there.
And adjusted for divestitures, that's a decline year over year. Right?
Down 2.6% adjusted year over year. So yeah, top line pressure is definitely still the story.
But let's talk about the margin, because that was the star of the show, you could say, adjusted EBITDA.
Right, $37 million, which is, get this, a 54% jump year over year. 54%.
Wow.
And the corresponding margin, adjusted EBITDA margin, hit 4.9%. That's up 180 basis points from Q2 last year. 180
basis points. I mean, that's not just fiddling around the edges. That suggests some real structural improvements in how they operate.
It does. But here's the thing. Despite that huge margin improvement, the stock basically ended up flat or muted, which tells you the market skepticism about growth, about that top line, is still weighing heavily, maybe heavier than the cost cuts are lifting.
So the obvious question is, where did that 54% perceived EBITDA boost actually come from? Was it, sustainable execution or maybe some one-off factors?
Well, management pointed to two main things. Ongoing cost efficiency programs, which they've been working on for a while.
Right.
And the increasing impact of their AI initiatives. They seem to be getting real traction there.
Okay, let's dig into specifics then. The government segment, I saw the margin there just exploded.
Oh, yeah. Adjusted EBITDA margin in government soared 520 basis points year over year. 520.
Incredible. How?
Directly tied, they said, to efficiency gains and using AI. Specifically, it led to lower fraud losses, reduced labor costs, and even lower telecom expenses on those public sector deals.
So AI isn't just talk, it's actually hitting the P&L.
Seems like it, at least in that segment. But we need to be a little careful analyzing profitability, especially when you look at transportation.
Okay, what's the catch there? Revenue growth looked strong, 7.1% year over year.
Revenue was strong, yes. But the margin expansion there got a bit of a, let's say, artificial boost from a specific event.
The sort of lumpy contract impact we sometimes see.
Precisely. They hit some major milestones on a big transit contract in Australia. Involved a contract amendment, also buying back a non-controlling interest.
Right.
Which resulted in a positive catch-up adjustment flowing through this quarter's numbers.
Yeah.
It's good news, obviously, but it makes comparing margins tricky.
Yeah, it definitely complicates the is this sustainable question if you have those kinds of one-offs.
Exactly. It highlights the challenge.
Yeah.
You need consistent big deal flow or other improvements to maintain those rates.
Okay. Critical context. So despite that revenue softness and the lumpiness, management felt confident enough to actually maintain the full year revenue guidance.
They did. Still guiding $3.1 billion to $3.2 billion for FY25 adjusted revenue. But, and this is key, they increased the midpoint of the adjusted EBITDA margin range.
Oh, really? So they're even more confident on costs.
Seems so. They nudged the margin guide up to between 5.0% and 5.5%. To me, that's management saying, look, we can't entirely control client volumes or budgets right now, but we absolutely can control our costs. That's the promise they're making, loud and clear.
Okay, makes sense. Now, let's pivot back to the revenue problem. That 2.6% adjusted decline, where was the main pain point?
Primarily the commercial segment, down 5.9%.
Ouch. Why?
It's still largely concentrated, which is, both bad news and maybe slightly better news because it's focused. They pointed again to ongoing volume declines with their single largest commercial client.
So that issue hasn't bottomed out yet?
Doesn't seem like it, or at least not convincingly.
Okay.
Also, the government segment dipped slightly, down 2.9%, but that was mostly expected as some large implementation projects wound down or finished up.
Right, the natural cycle of projects. But looking forward, were there any green shoots in the sales numbers?
Yeah, a few things to watch. ACV signings, that's annual contract value, were $150 million. That's actually up 6% year over year.
Okay, that's positive.
And maybe more crucial, the pipeline of potential deals, the qualified ACV pipeline, it's still looking pretty healthy at $3.3 billion. That's up 5% year over year, too.
So the pipeline is there. Did management explain the Q2 miss then? Just timing?
Pretty much. They talked about deals moving to the right, corporate speak for delays.
Right, but delays because the client is getting nervous about the economy or delays because Conduent is maybe losing out. What was the feeling?
They sounded pretty confident it was timing, not competitive losses. They're actually forecasting better commercial performance in Q3.
Okay.
And they're really banking on stronger ACV growth overall in the second half of this year to set them up for actual revenue growth in 2026.
But the market's basically saying, show me, right? Prove that big client's volume issue is truly over.
Exactly. Prove it.
Okay, they've shown they can manage costs. Let's talk about what they're doing with the cash that generates. Capital allocation is pretty key here.
Yeah, it's central to the story. Liquidity looks good. They ended Q2 with almost $300 million in cash. Plus, they have that $550 million revolving credit facility, mostly untapped. So plenty of dry powder available.
And they're using it for buybacks, I saw.
Oh, definitely. They kicked off a new buyback program, $50 million over 3 years.
Yeah.
And importantly, in Q2, they bought back about 2.7 million shares.
At what price?
Average price was around $2.70. Remember that number? $2.70. It signals what management thinks is cheap.
Good point. And what about selling off assets? The portfolio rationalization?
Phase 1 is done. Proceeds collected.
Yes.
Phase 2 is actively happening now. They said a couple of deals are in the marketing phase.
Any timing on that?
Management sounded fairly optimistic, saying they believe something will get done, will transact by the end of this year.
Okay, that could definitely fuel more buybacks if it happens. And the balance sheet, leverage.
Net leverage was 2.7 times. Management was clear. They see this as the peak for the year.
A high watermark.
Right. They expect it to tick down sequentially in Q3 and Q4 as EBITDA hopefully improves.
Got it. Let's switch gears slightly to innovation. That's the longer-term engine, right? How are they thinking about AI?
Yeah, they were keen to frame AI not as like replacing people, but as a structural enhancement to their services, using their own platforms to build in differentiation, think fraud reduction, making things simpler for the end user.
Yeah.
That seems to be the focus.
And are they actually doing it, or is it still mostly PowerPoints?
They claim they're in execution mode. Mentioned 8 key AI initiatives already in production, things like item processing, contact center work. So it suggests real activity, not just, buzzwords.
Right.
And we saw some specific examples. They mentioned expanding their Fairmarkit AI procurement tool, and also that SNAP card security feature, the lock and lock function.
Oh, yeah, I saw that.
That's now live in its 12th state.
That's actually a great example, isn't it? Like, relatively simple tech using their existing infrastructure, but it solves a real problem for users and for the state, reducing fraud.
Exactly. Small, scalable wins like that are what they hope add up over time, expanding their share of wallet.
So stepping back, the overall story, the transformation arc, it feels like they're moving past the fix the basics stage.
Yeah, shifting from balance sheet repair and just simplifying things towards really trying to leverage these focused platforms and improve the economics, the unit economics of their services.
And hitting that 5.0% to 5.5% margin target this year is basically the litmus test for that whole strategy, isn't it?
Absolutely. That's the near-term proof point.
So for you listening, the things to watch in Q3 seem pretty clear. First, can they convert that transportation backlog? Second, how quickly can they implement these new government requirements, like around Medicaid redeterminations and SNAP fraud stuff?
Right, that could be a tailwind.
And third, the big one, has that large commercial client volume really hit the floor?
That's the million-dollar question, or maybe billion-dollar question here. Management sticking to their knitting, cost discipline, returning capital.
But the big picture risks are still out there. Public budgets tightening, how fast commercial demand really comes back. Those will dictate if they hit that 2026 growth ambition.
For sure. And the flat stock reaction tells you the market's still very much focused on that top-line uncertainty.
Which naturally brings us to our favorite part of the deep dive, where we talk hypotheticals. And remember, folks, this is absolutely not financial advice, purely analytical discussion.
But If you're looking at this purely analytically, you might see a setup shaping up. A conviction play, maybe.
Based on management executing on what they can control, right?
Exactly. So here's the hypothetical pitch. You consider going long CNDT. And maybe you fund it by shorting something broad, like the industrial SPDR, XLI, or perhaps a high-flying BPO peer that trades on a much richer multiple.
Okay, explain the thinking there.
It's anchored in everything we just discussed. Management is laser-focused on profitability. That 5.0% to 5.5% margin guide is a stake in the ground.
Right.
And they are aggressively returning capital, buying back shares at prices they clearly think are low. Remember that $2.76 average buyback price?
Yeah, sends a strong signal.
So this trade idea is essentially a bet on two things happening. One, management successfully pulls off those phase 2 divestitures before year end.
Which generates cash.
Generates cash to accelerate capital returns, meaning more buybacks probably. The idea is this creates a kind of hard floor under the stock price, even if revenue stays a bit, lumpy or noisy for a few quarters.
So you're betting the things they can control, margins going up, share count going down, will matter more to the stock price near term than the things they can't fully control, like that big client's volume.
That's the essence of it. It's a bet on the controllables outweighing the uncontrollables over, say, the next 6 months. Betting on that margin and buyback story gaining traction.
Okay, so let's wrap this up. Conduent's Q2. Definitely strong on the profit and margin front. A clear commitment to cost control and giving cash back to shareholders.
Yep, clear strategic direction there.
But set against that ongoing challenge of sluggish revenue, the transformation plan, it's working on costs, no doubt. That 180 basis point margin jump is proof.
It really is. So the key question left for you, the listener, to think about is this. Does management have enough firepower in innovation, in AI, in their public sector tech to finally get that commercial segment growing again?
Or will shareholder value in the near term really just come from selling off more pieces and buying back stock? Is that the main engine for now?
That's the tension. That's what defines the CNDT story today. Which side of that equation wins out?